Okay, so Warren Buffett, by the way, says that the intrinsic value of a company is equal to the sum of all the future cash that it will generate in its lifetime, discounted back to its present value.
Investment is the process of putting out money today to get more money back at some point in the future. And the question is, how far in the future, how much money, and what is the appropriate discount rate to take it back to the present day and determine how much you pay.
And that's exactly what we're calculating right now. Okay, so we're gonna take it line by line, and I'm very excited for what I'm about to teach you. So line by line though, the share price, we can grab that from Google. We have the share price right now, $113. I'm just gonna paste that right in there. Okay, now for the earnings per share, I'm gonna just grab this from the key ratios tab of Morningstar, and I'm just gonna use the $3.30, which comes from the trailing 12-month column. Now keep in mind, some people like to use free cash flow. Some people like to use the earnings per share, which is what we're going to do in today's example. Also, net income, if you want to value the company in its entirety, or the free cash flow as well could be used for that. And then at the end, you would divide that number by the shares outstanding to get a per share value. But for now, we're just going to use the $3.30. So I'm going to paste that into there. Now we need to make some estimates on how the earnings per share will grow over time. So one way we could do that is we can look at history. And I'm just going to grab all of these numbers. This is earnings per share over the past 10 years or so. And I'm going to paste that in here. And basically, so this is today. This is last year, the year before that. And if I drag this back, we can see that this is for the past 10 years. And if we want to see how the earnings per share has been growing over the years, we can do that like this. So we take this, divide it by the previous year, minus 1. So if between this year and this year, earnings per share grew by 83%. Now if I drag this out, we can see what the earnings per share growth rate per year has been. And then if we want to grab an average of that, we could do something like this. Divided by 3. Let's drag this out. Average earnings per share growth rate over the past few years. We've got 14, 10, 13, 13. So the number I'm going to use here today is 12%. Okay, so let me throw in some more years here. And I'm just going to drag that out. And we're going to say, all right, so next year, the earnings will be equal to 12% more than the previous year. So next year, if the earnings grow by 12%, it'll be $3.70 earnings per share. If we drag this out to 10 years, we can see by year 10, the earnings per share, if they grow at 12% per year, will be $10.25. Okay, so at the end, we're going to play around with our estimates and see what happens to the final result. But for now, let's just say that in years 11 through 20, earnings per share continues to grow every year, but only by 7% each year, not by 12%. So we're going to say, all right, this number is equal to this plus this multiplied by this. And I'm going to lock in that field so we can drag it out. Okay, and let's drag this out a couple more years. Okay, to 20. So in year 20, after the earnings per share has grown by what we're estimating here, earnings per share becomes $20.16. Now we're going to say over the next 10 years following that, earnings per share continues to grow, but this time now it's decreased. The company's becoming more and more mature. The company's earnings per share grows at 5%. And again, we're going to play around with all of these estimates once we get to that final number, but for now we just want to fill it in so we can get there. So that's what we're going to do. So let me just plop it in here now. So we're going to do this plus this times this. Lock in the field so we can drag it, and let's drag it out to 30 years. Okay, so remember that Warren Buffett says that the intrinsic value is equal to the present value of all the cash it will generate in its lifetime. So we're talking lifetime here, and we're using 75 years. So we're saying in the final years, from the year 31 to 75, its lifetime, that the earnings per share will actually start to decrease. We're going to say that every year the earnings per share decreases by 5%. Just for these estimates. Again, we're going to play around with it at the end. Okay, we're going to do this one last time. We're going to take the previous year's earnings per share, and then we're going to add that, increasing it, or in this case, decreasing it by 5% per year. And again, I'm just going to lock in that field, and let's drag this out. So this is now decreasing earnings per share by 5% per year. And we're going to drag it all the way out to the 75th year. All right. So earnings per share decreasing by 5% per year in year 75. Earnings per share becomes $3.27. All right, now let's go back to the beginning. And we're going to now include a discount rate. So here's the deal. $10.25 earned 10 years from now is not equal to $10.25 earned today. So what we need to do is we need to find the present value of that $10.25. So to do that, we need to know what rate we're discounting it at. So the discount rate, there's different schools of thought and different ideas of what discount rate should be used. Some people say it should be the rate of inflation, which would mean maybe using 3% or 4%. Okay, another way of doing it is using the rate that you could achieve by just throwing your money into index funds completely passively, low-cost index funds. So that's what we're going to do for this example, and I'm going to use 9%. So now let's calculate, we'll go back to the 10-year example. Let's calculate the present value of $10.25 in 10 years from now. So to do that, we take the future value and we divide it by 1 plus the discount rate to the power of the time period. So we hit enter and we see that $10.25 earned 10 years from now has a present value of $4.33. And so what happens is, let me just lock in that field here so that I can drag this across. And see now, if I drag this back to here, look at what happens in the present day. Remember, this is today. So it's saying that $3.30 today is worth the present value of $3.30. So I'm going to take that one away, and we can see that $3.70 next year has a present value of $3.39 today. So this is the present value line. And basically what I'm going to do is I'm going to drag all of this across for all 75 years as well. All right, so this is the present value of that future cash flow for each individual year. So I'm going to go back to the beginning now, and basically what we can do is we can do a sum of all the future cash discounted back to its present value. Remember, that's the intrinsic value calculation. So we're just going to grab the sum of all of this money. And by the way, notice that in the later years, the present value of $3.27 is equal to a penny, or in this case, if I added more decimal points, they would be like a fraction of a penny. Anyways, we're going to hit this enter to get the sum, and we're going to calculate here that the present value, or in other words, the intrinsic value, okay, the present value, in other words, is $123.81. So since the price is $113 and the present value is $123, that would mean buying Apple at this price of $113 is buying Apple at less than it's worth, based on these parameters. Okay, so now let's see what happens if instead, let's say we're going to be a little less optimistic and say that the earnings per share growth over the next 10 years, instead of 12%, will be 10%. So I'm going to change this to 10 and watch how the present value changes when I hit enter. Okay, so the present value now becomes $106. So if that were to be the case, then buying Apple at $113 per share would actually be overpaying because the true present value per share is $106. Okay, so we can play around with these amounts. Say we do think it's 12% that it'll grow, and say we don't think it'll decrease to 7%, but it will remain to 10%, and then in the following years it'll be 7%, and then instead of decreasing in its earnings per share, it'll just flatline or something like that. Well, now we have a present value of $169, and if you're under the assumption that this is the truth, then buying Apple at $113 means you're getting it at a good price because it's worth $169. Now I want to show you what happens when we change the discount rate, because there's some dangers that are involved with this way of calculating intrinsic value, because it really is going to depend on the parameters you enter. So if you enter a discount rate of 4%, for example, look what happens to the present value. It's saying that the present value of this company is $622. Well, obviously, if you're buying it for $113, you're getting it at a great deal because it's worth $622. So the discount rate used is very important. So we're going to put it back to 9%. So now I'm going to show you something very cool. So I want to show you the net present value. And basically, the net present value is equal to the cash outflows. So I'm going to put a negative on that. So I'm going to say negative $113 because that's money leaving your pocket. And then you add in the present value to get the net present value. So there's a positive net present value. And when you have a positive net present value, it means that it's a good investment. Now, if I were to change this and say that the discount rate or the rate of return required, we're going to explain that in a minute. If we say we need a 15% rate of return, well, now we have a negative net present value, which means this is not an investment you'd want to make because the present value is much less than the price. So here's something very, very cool. I'm going to put that back to 9%, and I'm just going to leave these how it is right now. So I'm going to show you the IRR formula, the internal rate of return formula. And the way this works is because, look, with the net present value and the IRR formula, they're kind of married together. So the inputs that are required to get to the net present value are the price, also the future cash, and then the discount rate. So instead of calculating for the price using an estimate of future cash and an estimated discount rate, since we have the price, it's a given, you can get it right here from Google, remember. Since we already have the price and we can make our estimates of future cash, then we can use the IRR formula to calculate for the discount rate, aka the rate of return, rather than using the net present value to calculate for the price using an estimated discount rate. So here's how that looks. So to do that, what I'm going to do quickly, because I want to just clear this away, is instead of grabbing this $3.30 from here, I'm going to grab it from up here. So nothing's going to change, just where I'm grabbing it, because I want to be able to delete those fields. So I'm going to take this, and it's actually going to be here. And same thing for here. It's going to come from here. So nothing's changed. You can still see that. So that way I can just delete this here. And what I'm going to do is I'm going to put this number here is the negative of the current price. So basically today we're going to spend $113, and then here's the money we're going to get in the future, right? So I'm going to show you the IRR formula. The IRR formula looks like this. Equals IRR, and then we grab all of the outflows and inflows of this investment and hit enter. And let's add a couple more decimal points here. It's saying our internal rate of return, our IRR, is 11.173%. So in other words, this is our expected annual rate of return. All right, so watch what happens here now if I take this number and plug it into the discount rate. Watch what happens to the present value and the net present value. So I'm going to just paste it in here, boom. Now see what happened to the present value? The present value became equal to today's share price, and the net present value became equal to 0. So the IRR is calculating for the discount rate that gives you a 0 net present value. So what we've calculated here is that buying Apple at this price is going to achieve an annual rate of return of 11.173%. That's pretty cool, right? By the way, if you're getting value from this, please hit the like button on this video and share it with somebody that you think is also going to get value from it. All right, so here's the next thing I want to show you is we still have these estimates here. So if we're going to go back to being more conservative and we say it's going to grow 10% over the next 10 years, and over the next following 10 years is going to grow by 7% again. Then following that, it'll be 5%, and then the earnings per share will decrease by 5%. We're now seeing that the IRR, expected annual rate of return that you'll achieve on this investment, buying it at this price based on these parameters, will be 8.5%. And again, if I take this number and I paste it into this discount rate spot here, you'll see that this has populated to equal the present value of $113, net present value of 0. So what you've just learned about this IRR formula is it gives you a way to compare investments against each other. So say we did this exact same thing for a few other companies like Coca-Cola, McDonald's, Pepsi, Starbucks, etc., etc., etc. And then we were basically able to see the expected annual rate of return for each of those potential opportunities. And then you could choose between them which of these investments is going to give me the highest annual rate of return. And that's the one you're going to choose as the best investment. Now remember, with the discounted cash flows formula, it really depends on what your inputs are. So this growth rate is a huge factor. If you misestimate future cash flows, then you're going to be way off. So that's something you're going to really want to be conservative about. And when you hear Warren Buffett and Charlie Munger talk about margin of safety, and really all great investors talk about margin of safety, what they're really saying is just to be very conservative with your estimates for the future and basically make an investment decision that is a great investment decision even with the most conservative estimates. That's pretty much all margin of safety is. It's just be conservative. All right, so by the way, this is a good point to remind you that I'm not a financial advisor. I'm not your financial advisor, just a guy on YouTube. So seek advice from a qualified professional before you make any investment decisions. Okay, let's just back up for a second and do a little recap, all right? Here's the deal. When you buy a business, whether that's in its entirety or just a percentage of it through shares of its stock, what you're doing is you're making an investment. You're putting out money right now with the expectation and the intention of receiving more money back in the future, right? That's an investment. The intrinsic value, or fair value, whatever you want to call it, of your investment is equal to the total of all the future cash that could be returned back to you in its lifetime. That's all. Then, if we want to add one more layer of complexity, we can say, well, look, the value of a dollar earned in the future isn't the same as the value of a dollar today. So to really know what that future cash is worth today, we need to discount that future cash back to its present value, or in other words, the intrinsic value or fair value. How good your investment returns will be will depend on how well the business does, but it will also depend in large part on the price you've paid for your investment. Because look, no company is so great that it can be just bought at any old price and still be a good investment. That's right. It's just like how paying way too much for a rental property would be a bad investment, even if it was a great property, right? How great an investment is tied directly to the price you pay for that investment. And that same rental property could be a great investment if you got it for a great price, or even at the very least, a fair price. Well, it works the exact same way with stocks. The discounted present value of future cash method of calculating intrinsic value, what we just did together, is theoretically the correct way of valuing an investment. And it's the gold standard for valuation. So it's not just Warren Buffett that says this. It is generally accepted. And you just have to remember to be very conservative with your estimates. Valuing investment opportunities in general in this way turns them all into financial equivalents. As Buffett said in his 2000 shareholder letter, just insert the correct numbers and you can rank the attractiveness of all possible uses of capital throughout the universe. The investment that will give you the highest return is the one you should buy. And this is the framework that you need to think within. One quick thing to add on to our calculations from earlier. In our calculations, we used earnings per share, which is going to be good to use for most companies. But in an upcoming video, I'm going to show you something very special. It's a metric that Buffett calls owner's earnings. And I would encourage you to maybe use this instead. So just make sure that you're subscribed so you don't miss that video when it comes out. All right, now I want to show you a clip of Warren Buffett and Charlie Munger talking about the ideal business to invest in and how they calculated the intrinsic value of Coca-Cola when they made that stock purchase.
We want to be in the business that 10 years from now is earning a whole lot more money than it is now, and that we will still feel good about the prospects of the business at that time. That's the kind of business we're trying to buy all of, and that's the kind of business that we try and buy part of. And then sometimes we buy others too. Charlie?
We don't do any of that rigid formulaic stuff.
There's a general framework that you can call a formula in our mind, but we also don't kid ourselves that we know so much about the specifics that we would actually make a calculation in terms of the equation. When we bought Coke in 88 and 89, we had this idea about what we thought the business would do over time, but we never reduced it to making a calculation. Maybe we should, but we don't think there's that kind of precision to it. We think it's the right way to think in a general way, and we think if you think that you can do it to pinpoint it, you're kidding yourself, and therefore we think that when we make a decision, there ought to be such a margin of safety that it ought to be so attractive that you don't have to carry it out to 3 decimal places.
Notice how they said they didn't actually do any calculations because they look for opportunities that are so attractive that no calculations are required. In other words, they just wait for the very obvious great opportunities and then pounce on them when they come around. But he makes the point that the discounted future cash method is the framework that they do use to think about it, even if they don't actually do the calculations like we did earlier in the video. Okay, here's another clip, and this one is of Charlie Munger responding to someone who's asked him what his exact formula is for calculating intrinsic value.
Well, I can't give you a formulaic approach because I don't use one. And I just mix all the factors, and if the gap between value and price is not attractive, I go on to something else. And sometimes it's just quantitative. For instance, when Costco was selling at about 12 or 13 times earnings, I thought that was a ridiculously low value just because the competitive strength of the business was so great and it was so likely to keep doing better and better. But I can't reduce that to a formula for you. I like the cheap real estate. I like the competitive position. I liked the way the personnel system worked. I liked everything about it. And I thought, even though it's 3 times book or whatever it was then, that it's worth more. But that's not a formula that anybody. If you want a formula, you should go back to graduate school. They'll give you lots of formulas that won't work.
It's pretty funny, right? I was actually at that shareholder meeting in Omaha in 2018, and it was a good time. Notice though how it's not about a formula. Now, I don't want the fact that they don't use a formulaic calculation to discourage you. The fact is that in time, you probably won't need to use one either. What I'm trying to tell you is that it's just simply understanding that a company's intrinsic value is equal to the present value of its future cash is what's important. The understanding itself, and not necessarily actually doing the calculations. However, in the meantime though, definitely do go ahead and use the calculations to your heart's desire. It definitely won't hurt, and will just make your understanding of it a little bit stronger each and every time you use it. Okay, now I saved the best one for last. This one is a clip of Buffett and Munger answering someone who is asking about how many years to go out into the future when they do their intrinsic value calculation. And remember, in our calculation for Apple that we just did, we used 75 years. Okay, now listen to what Buffett and Munger have to say.
I have a question. When you're valuing the companies and you discount back the future earnings you talked about, how many years out do you generally go? And if you don't go out a general number of years, how do you arrive at that time period?
Well, that's a very good question, and it's the heart of investing or buying businesses, which we regard as the same thing. And it is the framework in which we operate. I mean, we are trying to look at businesses in terms of what kind of cash can they produce if we're buying all of them, or will they produce if we're buying part of them, and there's a difference. And then at what discount rate do we bring it back? And then I think your question was how far out do we look and all that. Despite the fact that we can define that in a very kind of simple and direct equation, we've never actually sat down and written out a set of numbers that to relate that equation. We do it in our heads in a way, obviously. I mean, that's what it's all about. But there's no piece of paper, and there never was a piece of paper that shows what our calculation on Hellsberg's or See's Candy or the Buffalo News was in that respect. So it would be attaching a little more scientific quality to our analysis than there really is if I gave you some gobbledygook about, well, we do it for 18 years and stick a terminal value on and do all of this. We are sitting in the office thinking about that question with each business or each investment. And we have discount rates in a general way in mind, but we really like the decision to be obvious enough to us that it doesn't require making a detailed calculation. It's the framework, but it's not applied in the sense that we actually fill in all the variables. Is that a fair way of stating it, Charlie?
Yeah. Berkshire is being run the way Thomas Hunt Morgan, the great Nobel laureate, ran the biology department at Caltech. He banned the Frieden calculator, which was the computer of that era. And people said, how can you do this? Every place else in Caltech, we have Frieden calculators going everywhere. And he said, well, we're picking up these great nuggets of gold just by organized common sense, and resources are short, and we're not going to resort to any damn placer mining as long as we can pick up these major aggregations of gold. That's the way Berkshire works. And I hope the placer mining era will never come. Somebody once subpoenaed our staffing papers on some acquisition. And of course, not only did we not have any staffing papers, we didn't have any staff.
If you like this video, please share it with one person. Nothing can help this YouTube channel out more than you doing that. And if you can't think of anyone to share it with, then please at least hit that like button for me. It really helps out. And if you want to keep learning, I made another great video for you right over here. So click here or tap here and I'll see you over there.